Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market updates: IGV versus SOXX, NFLX, TSLA, WMT, and SNDK. This video presents a direct informational narration of the source document. Looking at the source document, here's what we're covering today. First, macro data and the market overview. Second, SNDK's buybacks and guidance. Then, we'll dive into Netflix's fundamentals and technicals, followed by Tesla's key trading levels. After that, we're looking at Walmart and consumer staples, and finally, we'll break down the divergence between the software and semiconductor sectors.
All right, part one, macro data and market overview. Let's get right into it.
So, according to the source material, all four major indices were up today, with the Nasdaq leading the charge. We saw 319 S&P components advance, and there was some really strong volume pushing into financials, consumer discretionary, and consumer staples. But here's the real standout: the macro data. July PPI came in flat month over month, which actually missed the 0.2% expectation. Year over year, it fell to 4.7%. Why is this a big deal? Well, this lower than expected producer inflation is giving the market some serious hope that the Federal Reserve will hold rates steady in September. On the flip side, initial jobless claims did tick up a bit to 209,000 compared to the 202,000 estimate. Moving right along to Section 2, S&DK buybacks and guidance. Let's see how this macro picture filters down to individual stocks. The source highlights that SNK had a massive catalyst today, announcing a huge $15.5 billion share repurchase authorization. To put that number into perspective, based on an approximate $200 billion market cap, that move essentially wipes out nearly 7% of outstanding shares. That's a massive reduction in the float, and it's exactly what drove today's 13% rally. But that's not all. The document also points to a second massive catalyst: updated forward guidance for fiscal years 2028 to 2030. They're projecting a 50% adjusted free cash flow margin, revenue growth hitting somewhere between 15 and 25%, an 80% non-GAAP gross margin, and a 75% operating margin. It's a brilliant setup, basically signaling to investors that sustained high margins are on the horizon, and those excess cash profits, they're going straight back into those buybacks. Now, before we get too carried away with the hype, the source document issues a really stark warning about leverage. Volatility is just incredibly high right now. Take this data point out of Korea, for example. At one specific brokerage, 62% of accounts held by investors aged 20 to 30 faced complete liquidation. Why? Because of explosive leverage. The key takeaway here is absolutely crucial: protect your principal. You've got to manage your stop losses strictly, and definitely do not blindly chase upward momentum. Okay, Section 3, Netflix fundamentals and technicals. Has Netflix finally found its bottom? The source notes it broke above the 78.2 level today on high volume, marking its first real breakout after 3 straight weeks of sideways consolidation. But breaking past that heavy structural resistance near the 100 level in the short term is going to be tough. The reason? Even though the 5-year compound growth looks fast, the expected growth is actually projected to slow down by 2027. That makes that 100 zone a heavy resistance area of trapped capital. That said, if you're willing to hold for a year or more, long-term positions accumulated below 77 are still a viable zone, especially as their advertising revenue models keep developing. Up next is Section 4, Tesla key trading levels. Let's map out Tesla's technical postures so you aren't caught on the wrong side of momentum. According to the document, it's currently operating right at the upper edge of its lower oscillation bound, which is strictly defined between 315 and 368. The absolute crucial point here is to not chase breakouts at these current levels. You really have to wait until that 368 resistance is decisively cleared. Only then does it actually target the 415 to 465 range. Buying in before that definitive clearance carries a really high risk of it just reversing right back down to the bottom of the current channel. Now for Section 5, Walmart and consumer staples. The source observes a really fascinating rotation of institutional capital moving right into consumer staples. Just look at the sector ETF. It gapped up aggressively today on high volume, completely breaking out above that crucial 85.3 resistance level. Now it's perfectly positioned to test previous highs. And as a major heavyweight in that sector, Walmart's chart structure is absolutely one to keep an eye on. It's been hovering right at its 200-day moving average on shrinking volume, which points to a completed bottoming structure. The near-term strong resistance sits at 117 to 121, and clearing that opens a direct path to a new high target of 135. Now, yes, its valuation is currently at a historical premium, actually exceeding historical volatility bounds. But the market is clearly pricing in a premium for their super successful e-commerce and digital transition.
And finally, Section 6, Software versus Semiconductor Sectors.
To wrap things up, the source document highlights a highly unusual intraday divergence that kicked off at exactly 2:30 p.m. today. Semiconductors sold off heavily and just dived, while software saw a rapid, aggressive volume spike. This completely inverted the dynamic we saw in the previous session, showing some incredible relative strength for software.
Based on that massive volume in software, the document lays out a breakout timeline. Basically, if software successfully pushes past its 107 resistance, we can expect semiconductors to follow suit shortly after and challenge their own heavy resistance at 580. The argument here is that shorting semiconductors right now is a really dangerous game. Sustained massive capital expenditures, like NVIDIA's new revolving credit facility, are expected to drive real profit growth over the next 6 months.
However, there is a catch. The document points out that the software sector is showing a clear daily level top divergence in its technicals. Mathematically, this condition requires a repair. That repair has to happen either through an immediate downward drawdown or a brief upward surge followed by a sharp pullback. So even if there's a breakout, the technical setup suggests a necessary repair phase.